VinjaGPT.com.
Welcome back, investors. Welcome to a new video. So this time we're going to be speaking about a very well-known company which is called Alibaba. I presume that you know the company. It's like the Amazon but in Asia, and more specifically in China. And I want to share with you some key insights that I was able to research on the company. So as always, do not forget to subscribe to our YouTube channel if you're interested in getting our weekly updates. So the next companies that we'll be discussing about and analyzing will be L'Oreal. We're going to speak about Baidu, Tencent as well, Starbucks, Apple. So do not forget to do that. As always, a quick introduction and disclaimer. So compared to the previous video of LVMH where I had to disclose that I am a shareholder, so this time I'm not a shareholder of Alibaba. And actually I have been asked already by a couple of investors why I have not invested into Alibaba, because for example Charlie Munger has been heavily invested into the company. The main reason, for those who know me and follow me, is that when I invest into companies, there are for me two ways of making money: is buying the company below intrinsic value with a 25 to 30% safety margin and then selling it like 15% above intrinsic value. And the second way of making money is while my money sits still, I want to be remunerated for my patience. So I want to see cash dividends coming to me, in fact. So that's the way how I invest into the stock market. And also on top of that, one thing that I want to share as well is that prior to that, and now I have also a kind of different opinion about Alibaba, or let's say I have strengthened my opinion that I would not invest into Alibaba. And in full transparency, I had not read the financial reports of Alibaba before. I was just aware that they would not sell, or they would not pay actually any cash dividends, so I stayed away from it. But I read now a little bit more, and I have some insights that I think are very interesting that I want to share with you. And again, that's why I'm putting this in orange here. The importance, really the thing that I really emphasize is, as an investor, as an equity investor, you need to read the financial reports of the company that you invest into. There are 99% of the people who are not doing this. And as always, remember that investing into the stock market comes with a certain amount of risk, so you may lose actually your money. So always stay attentive to that, of course. Right, as always as well, you know me, I'm using Midjourney for some generative AI images, which is the case here. So I've put you the prompt. If you're interested, you can redo the image on Midjourney as well. So let's start first with Alibaba, the history. So this picture on the left is a very famous picture where you have Jack Ma, the founder of Alibaba, sitting with the 17 other co-founders of Alibaba in a Hangzhou apartment. I think it was actually Jack Ma's apartment in 1999. This is where everything actually started. The year after, they raised private equity money, and the year 2001 started to become profitable, in fact, because they wanted to allow people from even within China to be able to sell their goods. And so they created things like Taobao, they created Alipay, they also became listed on the Hong Kong Stock Exchange 2007, so until then they were not listed. And so they created Taobao Mall, which is called Tmall today, which is a B2C platform. And of course, you probably know them also for their offerings on AliExpress, and maybe also for Ali Cloud, which is the Alibaba cloud computing service, similar to AWS and Microsoft. And so AliExpress actually was launched in 2010, and Alibaba Cloud Computing was actually launched the year before 2009. So in terms of management, because you saw in the first image in the thumbnail, I've put Jack Ma, but actually Jack Ma is no longer involved in Alibaba. That's, I think, a wrong perception that people have still about Alibaba, and I want to be precise here. So Jack Ma was the CEO, so you've seen in the previous slide, let me show you again here, so that he created with 17 other co-founders Alibaba in 1999. So he remained the CEO of the company until 2013. Then 2019, he stepped down as chairman, so chairman of the board of directors. And he was actually no longer associated to Alibaba. Apparently between, what I was able to read in the news in around January 2024, so very recently, he bought, if I remember well, it's like 15 million of shares. So that's like a 3.7% stake in the company. But as it is below 5%, you will not see it popping up in the financial report of Alibaba Group Holding, in fact. Today, in fact, the ones who run the company is, the most important one is Eddie Wu. He's the CEO of the company, of the Alibaba Group. And then you have Joe Tsai. If I remember well, he was also one of the co-founders. He's currently the chairman of the board of directors for Alibaba Group. So you can see these as well in the major shareholders. So in the report, so this is like the proxy statement for those who know US proxy statement reports, like the DAF 14A report that is requested by the US SEC. So here you see actually the main shareholders. The main shareholder remains SoftBank. That's a Japanese bank. They are invested with 14.2%. Then you have Joe Tsai, so the chairman. He has actually around 1.4% ownership. And then they are not mentioning it specifically what are the ownership percentages or stakes for the various directors and executive officers of the company. But in total, they have around 1.8%, but it's not being disclosed actually here. So the largest shareholder remains SoftBank, in fact, with 14.2%. The company is actually incorporated in the Cayman Islands. I will come back to this. And you can buy the company through, let's say, in 3 ways. One form is buying what is called the American Deposit share, which is an ADS. So that's a mirror of the original share, but sold through an American broker on the US market. So actually the company IPO 2014, they raised 25 billion. It was at that time the largest IPO, so they raised a huge amount of money. I think at the end of the day, if I remember well, the share price had increased by 38%. So you can buy on the New York Stock Exchange Alibaba through an ADS, so American Deposit share, under the ticker BABA. But you can also buy it on the Hong Kong Stock Exchange, either on the Hong Kong dollar counter with the ticker 9988, or you buy it on the renminbi counter, which is not the Hong Kong dollar currency, it's the Chinese currency, under the ticker 89988. So probably I would expect that very probably most of you, if you have an ownership, you're thinking of taking an ownership, is going to be through the BABA, which is the ADS ticker in the US. In terms of shares, and you're going to see why I'm going to go a little bit into this before speaking about what the company is doing, the main products, the business lines, the growth, etc. The company has just one class of common shares, but it's represented through American Deposit shares with one ADS representing 8 common shares. You have the amount of outstanding shares. And what is interesting as well is that 34.7% of the total outstanding shares are owned by 171 record shareholders, which are actually registered in the US. So a third of the company is being owned by US owners, or at least brokers. Sometimes you don't know exactly who is the one owning the share. It's just carried as this called holding under a street name on behalf of customers. So coming back to one thing here, and I mentioned Cayman Islands, and this is a little bit unusual, right? And I mean, I will not go now into any political or money laundering comments, etc. But you have those countries where it's more easy to set up companies. And it's the same for the US. A lot of companies are set up in Delaware because they grab some benefits out of it. You have the Cayman Islands, the Virgin Islands. You have in the UK, Guernsey and Jersey Islands, for example. But here what I was surprised, and as I said earlier, I never looked in detail into Alibaba, but I did for this video, for the purpose of this video. I was surprised to see that the company is incorporated in the Cayman Islands. So I was like, let me be a little bit more curious and let's go into it. So, of course, what I had to do I tried to simulate a potential investor into Alibaba is I downloaded the latest financial report, and which is 341 pages. That's huge. And I read the report. I need to be fair with you. I didn't read the 341 pages. I probably read like 50, 60, 70 pages, something like this, to get a sense of what is the company doing, and also more specifically, why this incorporation in the Cayman Islands, And I came across this figure, and they're very transparent in the report. Do not get me wrong. Alibaba Group, so the management and the board of directors is being very transparent about how they report the structure of the company. And actually what is very interesting and what struck me actually is what you have on the left-hand side is that Alibaba, being incorporated in the Cayman Islands, then has a certain amount of subsidiaries. That's not necessarily surprising. Those are called offshore PRC. So PRC is a Popular Republic of China. And then you have those companies that own companies in China that are called onshore PRC. You see this on the left-hand side, where you have now a difference between legal entities that are offshore, so not in China, and other ones that are incorporated in China. And then I came across, and I will explain this in the next slides, I came across, if you look at the bottom right of this diagram, you see actually that there are two types of lines. You have equity interest and you have contractual arrangements. And I was like, 1 second, let me go deeper into this. What is happening here? And I read this through. I'm making the summary here for you guys. So what is happening is that, and China has some restrictions on foreign ownership of some, let's call them strategic economic activities, which Alibaba is part of, like telecommunication services, for example, where actually China is not allowing foreign ownership. So I mean by that shareholdership of those companies. And this is basically where these contractual agreements come into play. So when you have the non-dotted line, so the straight line, which is an equity interest, so this is a standard ownership, equity ownership of a subsidiary of Alibaba Group Holding Limited. But then when you look at the contractual agreements and you actually see, and I've taken the snapshot or the screenshot from the financial report, I'm just taking here the bullet points 1, 2, 3, 6, 7, and 8, which corresponds to, at the bottom right of the screen, which corresponds to the activities of Taobao Mall, which is called Tmall, Alibaba Clouds, AliExpress as well. So basically, and Alibaba is mentioning this in the financial reports, is what they're mentioning is that the core of the business of the operation of Taobao Mall, of Ali Cloud, of AliExpress has a contractual arrangement with companies that are fully owned by Alibaba Group, which means that Alibaba Group is not owning those companies. Okay, so I think that's a very important insight. And I will come back to this later on, but what I can already share here is that basically when you are buying a share like the ticker BABA on the New York Stock Exchange, you don't own those companies. Those companies, Alibaba Group Holding, through their subsidiary structure, is not shareholder of those companies, but they do have a contractual agreement with those companies. And this is what is called, and my apologies, this is maybe a little bit more technical, but this is what is called a variable interest entity, in fact. And what are what I call VIEs, variable interest entities. So, and here you see, and this is again a screenshot from the financial report. Alibaba is being very transparent about this. They say, listen, we do have, and this is imposed by the Chinese government, and probably you have other countries in the world that are doing the same, which I could understand. We have a certain amount of operations that fall under these restrictions that they cannot be owned by foreign shareholders. So the only way that foreign investors can actually bring money into Alibaba is through this structure of VIEs, which means that when you are buying Alibaba on the stock market, you are buying the holding, which is incorporated in the Cayman Islands. Then you have a fully owned entity, so fully equity owned entity in China, but the substance of the operations, it's through the VIE. So the VIE is a company that is not owned by Alibaba subsidiaries, but the VIEs have like an exclusive agreement, contract with the companies that are fully owned by Alibaba. And that's something that you have to understand, because when you are buying Alibaba, you are not a shareholder of those VIEs. But as I was showing you here, and this is an extract from the financial report, they clearly mention that the main operation of Taobao Mall, Ali Cloud, and AliExpress are sitting in those VIEs, but Alibaba is not shareholder of those entities from a foreign ownership perspective. Okay, so pay attention to that. And so again, what is a VIE? So as said, it's a legal business structure where investors, they gain control, not by being shareholders of the companies, but through the fact that the VIE has an exclusive, for example, contractual or service agreement with the other company. And this is, so VIEs are set up, and this is the case when I will be analyzing Baidu, Tencent, and JD.com as well, which are very big Chinese players. You're going to see that this concept of VIE will actually come back, right? And now probably, I mean, for those who are a little bit more fluent in accounting matters, you may think about, yeah, but 1 second. if those companies which carry the substance of the operations of Taobao, Tmall, AliCloud, and AliExpress, they are not owned, what am I buying? And by the way, when I look at the balance sheet, the income statement, and the cash flow statement of Alibaba, are those companies part of it, yes or no? The answer is yes. And according to accounting rules, so if it is US GAAP or IFRS, when the VAI has an exclusive agreement, so services agreement, for example, with a fully owned subsidiary of Alibaba Group Holding, actually Alibaba shall consolidate the whole financials of the VAIs in the financial statements, right? That feels a little bit weird, because probably for those who are a little bit more fluent in equity investments, etc., you are used to when it is like more than 50%, it's fully consolidated, and you may have a minority stake that has to go back. Let's say that you give some part of your profits back to a minority, a non-controlling interest, but that's a technical term that is being used. So just pay attention to this, all right? So you are not owner if you buy into Baba. I'm not a Baba shareholder, but if I would have taken the decision to invest into Baba, that's the type of analysis that I would have actually been doing. And this is the type of thing that I'm sharing actually with you here. So when you read again on the risks, because there is always a management discussion and a management analysis that is being carried in the financial reports, specifically in the annual audited financial reports. The Alibaba management is clearly mentioning the reason of those VAIs. They clearly said there are some legal restrictions on foreign ownership and investment. So you need to be aware as investors that the VAI structure involves risk and is subject to uncertainties under local laws. And again, the point is not just about China here. You may have actually, I'm just thinking now, maybe, I do not know, I would need to analyze this, but maybe you have US military companies that are listed on the stock exchange where they don't want Chinese investors to become shareholders of those companies. So maybe the US has something similar, and maybe they have something similar to those VAI structures. I would not know. Again, I'm just guessing here. But the point is, it's not just specific to China. You may have governments throughout the world that will set up restrictions, so legal restrictions on foreign ownership, because just to protect the what is important, strategic assets of the country. So it doesn't come to me as a surprise. And they clearly say, the third bullet point, they clearly say in the report, we, and through us, our shareholders, do not own any equity interest in those VAIs. So you have been warned if something happens that you are not owners of that. But the balance sheet consolidates all the VAIs, even though the VAI has no ownership link with the fully owned subsidiaries of Alibaba Group Holding. And then there is something interesting I want to share with you. I don't want to go too much into the legal conversation, but I think it's important that you understand the risk. So Alibaba has a legal counsel, which is called Fangda Partners. I do not know the company. And Fangda is saying that the ownership structures of the representative VAIs, that they do not violate any applicable laws for the time being. But the advisor, and Alibaba is saying this, however, Fangda Partners has also advised us that there are substantial, so there are important uncertainties regarding the interpretation and application of current PRC laws, rules, and regulations. Basically, what they are telling us is, listen, if you buy into Baba, you have this uncertainty because the substance of the operation of the core business cannot be owned by non-Chinese owners. This is what it means, full stop. And if tomorrow the Chinese government would decide to change this, well, then actually what has been consolidated is actually a part of that would evaporate to some extent. And of course, let's be very fair also towards the Chinese government. There has to be some kind of trust that the Chinese government provides as well to foreign investors. But you never know. And I think what is important is that you understand, and I'm not saying it's good or bad. That's why I'm taking the example of probably maybe I would find in the US or maybe in Europe that some strategic assets that are linked to companies that are listed on the stock exchange, well, maybe that they cannot be owned by foreign ownership. So maybe Europe and US is doing the same through other, let's say, legal structures or legal, let's say, restrictions. I do not know. I would need to look this up, but I wanted to share this with you that you are aware of the risk potential linked to Alibaba. And I think it's good in terms of education that you get fluent in those matters. One thing as well, So of course, in the significant accounting policies, in the financial report, it's mentioned. So this is the extra of the 20F report, which is the, let's say, the American, when you're listed on the New York Stock Exchange, or when you're listed on the US stock market or stock exchange, and you are not actually incorporated in the US, but you may be listed in the US, so people can buy stocks in the US, but you're incorporated somewhere else. You have to file a 20F report, which is equivalent of a 10K report, the annual audited report. So this is an extra of the 20F report. And they clearly mention the consolidation includes, so the consolidated financial statements include the financial statements of the VIEs over which the company is a primary beneficiary for accounting purposes only. So they clearly say, we have consolidated in our balance sheet all the VIEs, but we do not own those VIEs. So just be aware of it, of the risk that is related to that, right? One thing as well that I wanted to read as well, and I came across something interesting I want to share with you, and I'm really trying to make it, let's say, in a summarized way here. Well, first of all, the latest auditor's opinion is fair. So they consider that the figures represent in all material respects in a fair way the operations of the company. Remember that financial statements are always imperfect. They cannot be perfect because it's a quantification of complex business processes. But what was interesting as well is that they actually changed the auditor. Don't ask me why. This is what I've put on the bullet point number 2. It's interesting to read that in item 16F, the Alibaba shareholders mention, and management is mentioning, that the decision to change our independent registered public accounting firm was not made due to any disagreements between PwC Hong Kong and us. So, okay, I do not know. Just be, of course, always attentive. You have to read that type of thing. It's interesting to see that they just changed their statutory auditor. Okay, so let's see what will happen in the future. Now, so this is one thing, I mean, I think it was important before we go into business performance and you start maybe thinking, should I invest into Baba or not? That, I mean, that you know, understand a little bit what are the major risks that are linked to this. And again, this is not to blame China. As I said, maybe US and Europe have similar, let's say, legal restrictions on foreign ownership of strategic assets. So let's look at Alibaba's business and financial performance. So the main businesses are Taobao. That's a customer-to-customer thing. It's very similar to eBay. In fact, if you know eBay, it's like an auction marketplace. Then you have Taobao Mall, which is called Tmall. That's B2C. Then you have Alibaba Cloud, which is pretty well known in Asia, which is the, let's say, competitor to AWS and to Microsoft Azure and Google Cloud, for example, Google Cloud Platform, but in Asia. And then you have actually the Alibaba International Digital Commerce Group, which is called AIDC, which includes what you probably know, which is AliExpress and Alibaba.com as well. And then they have other stuff, but we don't go too much into the details of it, but they have logistics, they have digital media and entertainment group, and also a lot of other stuff. It's really conglomerate. They have huge amounts of business activities. One interesting thing as well that I want to share with you, I mean, I've limited time to share this with you, is strategic investments and acquisition for the fiscal year 2024, as this is the financial report that we are looking into. They have acquired a 36% equity stake in this company, which is called Moonshot AI. And the company actually, it's a Chinese company. They use AI to improve if you are running an e-commerce website, the company is actually looking at the analytics and probably the ergonomics as well of the website, the user experience, the conversion rates, those type of things. And actually they can boost your e-commerce website sales. So this is what Moonshot AI is all about. So as I said, they have taken a 36% equity stake in the company, and that was rough cut 800 million that they invested into. So now in terms of revenues, let's look at the top line first. So just the revenue. So you see, in fact, that the company has been growing. So I'm just showing you here the last 3 years between 2022 2024. So 2022 2023, the revenue grew by 2%, and last year it has been growing by 8%. Remember that their fiscal year closes on March 31st. So those figures are in million US dollars. So basically their total top line is 130 billion US dollars. You see actually where most of the revenues are coming from. You see that Taobao and Tmall, that represents 44% of their revenues. You see that, for example, everything that is Alibaba International Commerce Retail, that would be AliExpress and Alibaba.com, that's the wholesale part, that's rough cut 10%. Cloud Intelligence Group, that's Ali Cloud, represents 11%. You see logistics as well is 10%, and you have all others that is 20%. But you see that most of the revenues are coming from Taobao, like half of the revenue of Alibaba Group comes from Taobao and Taobao Mall, followed then by Ali Cloud, like 11%, and then 10% the logistics part, and 10% the AliExpress and Alibaba.com website. When you look at profitability, we don't go too much into the details of it, but when you look at profitability, you see in fact that of course the company is making profits. It's not huge, but that's typical for such a large conglomerate. They're making like between 5 and 7% of profits, which is pretty decent. And you see the net income fluctuates between 6.5 billion US dollars, and for 2022, and now, so last year, 2024, so when they closed March 31st, 2024, they actually generated 9.8 billion US dollars of revenue on a top line of 130.3 billion US dollars, right? So you see, rough cut, though, they are profitable. That's not the point here. But one thing that has been surprising actually is the share price that came down. I mean, the share price, if you look, 2021, of course, there was something related to COVID to some extent, but not really, because COVID, the crisis on COVID hit actually spring 2020. 2021, we were actually already out of COVID, and the share price of Baba was actually around 319 US dollars at its highest value. And now it fluctuates between, let's say, 78 and 85 US dollars. Now, over the last couple of days, we are September 20th, it's gained a little bit of percentage, went up to 88. But what I could observe over the last month, it was fluctuating between 78 US dollars and 80, 83, 84 US dollars. So one of the things that we want to know, of course, is what is going on and what is the intrinsic value of the company. But first, I want to know, how do customers and employees feel about the company? So I'm asking Vinch here, show me the latest net promoter score and employee net promoter score of the company. So, I mean, of course, Vinch has those data points. And here you see, in fact, that the net promoter score is 0, at least from where we get the information from. The employee net promoter score is neutral as well. Customer satisfaction is pretty okay at 64%. Customer loyalty is 70%. So the CEO in the meantime has changed. So where we get our data from, I checked this before doing this video again. It still says Daniel Zhang, which is the previous CEO. Now there is so it's Eddie Wu, if I remember well, the CEO. So the CEO approval rate is at 69%, which is pretty decent. Recommend to friends, 73%, and the positive business outlook is 57%. So it's pretty okay. It's, I would say, on the higher side, specifically when we are looking here, we're looking at internet retail, right? So that's very, let's say, not stressful, but there is a lot of pressure on those companies, where you have other industries where it's a little bit more relaxed. So I think that the results are pretty decent. On the ROIC, I asked Vin, show me the return on invested capital evolution of the company from 2020 until August 2024. Now we are September, so we have the September figures, of course, as well. And you see, in fact, that, I mean, the ROIC is positive. You saw it already earlier on the profitability. The profitability was fluctuating between 5 and, let's say, 7-8%. And you see here that it came down indeed. And now, I mean, you see that it's a little bit below 10%, the ROIC, which is still very, very okay. You remember, I mean, for those who follow me, that I'm expecting for companies to have an ROIC of around 8 to 10% for the last 5 years. That's one of the KO criteria that I have for companies. And then I actually went into doing a full analysis of Alibaba with Vinch. So you have the prompts on the left-hand side. I will stop the video as well when needed. So the first thing, of course, I need just to check if Vinch, as long as we don't have memory available as a function in GPTs, that will hopefully come. But I just ask first, do you have Alibaba in your companies? Then I ask Vinch, perform me a level 1 analysis. So you see the share price 88.29. The mode is wide. You see already that price to earnings and price to free cash flow are pretty low at 21 and 10. Dividend yields, let me just stop here 1 second. Dividend yield, there is dividends. So they started actually paying out cash dividends, and they are also doing share buybacks. The dividend payout ratio is very sustainable at 51%. You see the ROIC is currently at 7.57%, and the return on assets. So the company is profitable, but it's internet retail. It's not hugely profitable as other, like luxury. Very often you have like those 20% ROICs, for example. My apologies, I have a cold. So debt to equity, that's one of the things that I look into as well. How much leverage does the company have? I mean, this company for the time being, except if the figures are wrong, but if the figures are correct, actually, this company will not go bankrupt. I mean, they have a debt to equity ratio below 1. So they have like 5 times more equity than debt. And even on top of that, the ratio below, cash to debt ratio, actually they carry 73% of the debt could be immediately covered by their cash position, which is just fantastic, right? So I don't think that the company, except if they would do stupid things management, I don't think that this company would go bankrupt. Short term at least, right? So of course, then you have Vinch. I mean, we have trained Vinch to provide you some kind of assessment. So basically what I'm now doing here in the video, Vinch will tell you this as well, either through text or through audio as well. Now then, what we're interested in is, of course, to evaluate the intrinsic value of the company. And there I'm prompting, I mean, here I'm doing the prompt, perform a level 2 analysis of the company. I could have asked, what's the intrinsic value of the company? It's the same. You will see on other videos I'm using different type of prompts. So here was interesting. You see that, so Vinch is using the data of Friday, September 20th Wall Street closing, and it Vinch is already telling you the assumption. So it's 3% growth rate, 7% discount rate, so cost of capital, and 30% projections. And you see here that, let me just pause here 1 second because my mouse was here. You see actually that the intrinsic values, so on dividends, as the company is paying low dividends, the intrinsic value on dividends, I would not consider that one. But if you look on discounted cash flow, discounted future earnings, it fluctuates between $140 a share and $72 a share on future earnings. But as you have learned from me, hopefully, that basically, I mean, you have seen that there are some assumptions in there, which are 3% on growth, 7% on cost of capital, and 30% valuation. I never do a terminal value valuation. And then I'm asking here, Vinch, what's the appropriate cost of capital for the company instead of the default 7%? Because you have seen that the company is in internet retail, and you're going to see actually Vinch pulling from its knowledge base the correct cost of capital that Aswad Damodaran considers for internet retail, so January 2024, which will be, I think, 9.something%. Yes, 9.82% actually. And what I will be then asking is, I think that 3% growth rate is maybe a little bit on the too defensive side. I'm asking Vinch, can you redo the intrinsic value calculations using 5% growth and the cost of capital that you just fetched from the knowledge base, which is basically 9.82%. So, I mean, the prompt you see, I'm writing, and the cost of capital you just retrieved. But beyond the large language model, yeah, here you see there was a small mistake on OpenAI. So I just regenerated the prompt, and then it came back with the results. They had some issues this weekend, so that happens. Here I just had to regenerate the, let's say, the submission of the prompt. And you see now it comes back with a certain price. Of course, the dividend discount model IV has changed as well. And you see now we are at $130 and $66. A share has not changed too much, even though I increased the growth, but I increased the cost of capital as well. So I'm dividing by a higher discount rate. So I'm just saying thank you to be polite with our friend Vinch here. So when you look at the intrinsic value, basically, you know that I always like to look at Morningstar, what they're saying. So Morningstar considers that at the fair value of a share of Baba is around $100. This is calculated on August 15th. So the price was $88.29 on September 20th, and they say that the company becomes super expensive above $155, and the company is very cheap below $60. That's a 5-star price that Morningstar uses. Here, when I use, so bringing back what Vinch has calculated for us, so I mean at $88, you have then to think, do I use the cash flow? Do I use the future earnings? But if you would just take the average between the two, which is a rough cut $90, you see that you don't have a lot of safety margin. So I would also consider that Alibaba today, at least, with those assumptions of cost of capital and growth, with 30-year valuation, is fairly valued. And of course, some people would say, yeah, but I disagree with you. I mean, I don't have a problem if you disagree with me. I'm just telling you how I would look at the company. So as a conclusion, to wrap up here, so the company has, I mean, it's a great company. It has a huge moat. I think before just looking at, do I have a safety margin to buy the company, which I believe today we don't have. For me, the passive income, so through cash dividends and share buybacks, is on the lower end. That's not the type of investment that I would put my money into, because I want to gain passive income while my money sits still. So as I said, I buy 25 to 30% below intrinsic value and I sell 15% above intrinsic value. And I recalculate every quarter the intrinsic value. So here, the only way for me making money would be on capital gain. So they don't pay enough dividends out, at least for the time being. And I don't have my safety margin on the intrinsic value. So I would probably just on that, I would stay away. But I need to be very fair. The thing about the VIEs, so the variable interest entities, and the legal risk that comes with it, which is that those companies that operate the substance of the operations in China are not owned, but they are consolidated in the balance sheet, but are not owned. If I would buy Alibaba Group Holding, that's for me like a little bit of worse feeling. So I would probably find another investment that would be better than Alibaba. With all respect, if Alibaba people are listening to this video, I mean, I love the company. That's not the point. I think you have, and the company has a very strong moat. But for me as a foreign investor, yeah, I would probably stay away for those two reasons. So is it a hidden gem? That was actually the core question. No, I don't think it was a hidden gem. With that, thanks for your attention. Do not forget to subscribe to this channel. If you have the opportunity, go and test vingpt.com. Maybe you're already a VinGPT user, so thanks for the VinGPT users out there. And stay tuned for the next one. So the next video will be about L'Oreal, which is a beauty and cosmetics company. So and then I will cover other companies later. With that, thanks for your attention. Talk to you in the next one. Bye-bye.